and welcome to this programme from Baillie Gifford, the latest in a series of webinars where we talk to the managers of the business's different investment trusts and funds. Today we're talking to Stephen Hay, co-manager of the Baillie Gifford Monthly Income Fund. My name is Amy Maxwell of Citywire, and I'll be talking to Stephen about how he runs the fund. So welcome, Stephen. Thank you very much for joining me today.
Thank you, Amy. Nice to be here.
Excellent. Well, to start with, let's learn a little bit more about the fund, because Baillie Gifford is obviously predominantly known for growth equities. So how do you turn this heritage on its head for income?
Yeah, I think that's right. Many of the strategies here at Baillie Gifford are what you might class as accumulation strategies. So they're just trying to grow clients' capital as much as we can and no requirement for income at all. So those are often in the best growth companies that we can find globally, and the likes of Tesla will be the names that will be associated with some of those strategies in the past. What we're doing here is we've got an income strategy. So those types of equities are just, they don't pay any dividends. Or if they do pay any dividends, they're small and they're very unreliable, inconsistent. So they're just not suitable for an income strategy. So what we're doing here is we're running monthly income. It's a strategy that pays a monthly income to people. That should be an attractive level, and we're aiming to grow that income in line with inflation, and also grow the capital in line with inflation. So to do that, we need to have some equities in there, and about a third of the portfolio is in equities, but there are a different type of equity than in other Baillie Gifford portfolios. So we actually have an equity income strategy here at Baillie Gifford, and we call it Responsible Global Equity Income, and that's available separately. But we use that fund within monthly income to provide the equities. And those types of equities they're very well-known global stable companies, but they pay an income that is typically decently higher than the index, and very stable and consistent and reliable, and looking to grow their dividends over time. So that's what the equities are doing. And then we balance that third in equities with about a third in real assets, property and infrastructure, and about a third in fixed income. And it's using the combination of all these asset classes allows us to give a really nice, reliable monthly income.
So is it fair to say then the portfolio ends up looking pretty different to many of the other funds and trusts within the group?
Yeah, that's absolutely right. So first of all, because it's got that mix of asset classes, that's quite different. A lot of our strategies are equity only, but it's having that income objective front of mind for investors. It's all about how you deliver that monthly income in a reliable and consistent way. It can grow that income over time. It needs quite a different mindset than that of a growth investor who is less concerned about the volatility and about any income that might be derived from the holding. So yeah, it's quite different.
Well, let's home into the macro side of things, because you've alluded to the fact that it's very volatile. You know, this is a marked change in climate for companies to and governments to operate in. So you used to be a Bank of England economist, so you have a fair idea of the inflationary sort of risk. So do you want to talk us through your view of the macro situation and how that's really impacting income investing for retirement?
Yeah, well, I think for an income investor, some things really have changed and are different, and some things are still the same. So in terms of what's different, we are seeing more volatility in markets. There's more uncertainty about the geopolitical environment, and one person in particular is responsible for that. But it's not just him alone. I think it is the world order that we are now in is a bit different, and that's causing people to be a bit more uncertain about what's happening. And some of that volatility can make it quite difficult for a retirement strategy where you're really prizing the certainty of that income over time. And so when markets are volatile, that presents quite a challenge. But I think you're also being presented with an economic situation where we've had a bout of inflation, a significant bout of inflation. We've had yields move up significantly. We've got a broader set of opportunities for an income investor than we had for some period, because cash is now viable. Cash pays a reasonable level of income, and bonds are paying a much higher level of income than they were before. So whereas before you might have really struggled to think about how you could earn a stable income from the bond side, or at night high enough income, you've got more options there. So there's definitely more opportunities available, but a lot more uncertainty. That's probably the differences that are there. But you've got the same old problem for an income investor, and thinking hard about how you deliver that reliable income and how much what is your strategy with dealing with that uncertainty and generating the income? Do you prize the certainty and retreat into cash and safe bonds, or do you try and stomach the volatility of the equity markets and have it all in an equity strategy which you cash out? So these problems have been there before, but I think at the moment it's probably even more obvious that those are difficult challenges, and our approach is definitely to be very fully invested in asset classes, but have a very diversified portfolio, and that makes it easier to generate the reliable income. So I think it's quite a good time to be an income investor because there are more opportunities. I don't think you should be too scared of the volatility, have the right approach, but the same old questions arise about how best to manage that.
I mean, you talked there about safe bonds. I suppose if we're looking at developed world economies now servicing huge debt burdens at higher interest rates, where are the safe bonds? Are they still with developed world governments, or should we be looking to corporates and different areas there?
Yeah, I think you have to be pretty selective these days, increasingly so. And you're absolutely right. You've hit the nail on the head. I mean, what we've seen in the last few months it's not been quite a Liz Truss moment in the US Treasury market, but there's been echoes of that. And I think it's now front of mind I'm a fixed income investor by background. I think it is front of mind for bond investors that, oh yeah, do you remember that we used to have bond vigilantes who used to run the show? And actually for 15, 20 years, they didn't do anything, had no power because there was very low inflation and there was QE, quantitative easing to buy bond supply. And that's now gone. You've got higher inflation. You don't have any QE. In fact, it's gone into reverse. Who's going to buy all these bonds out there? And that's been a bit of a problem. You saw only yesterday the Bank of England announced they were going to start selling more the Debt Management Office in the UK going to sell some shorter dated bonds, more of them rather than the longer dated, because if people are buying the longer dated bonds, they want an additional yield premium. So you've seen long dated bond yields rise in most of the developed markets. Japan's actually led the show recently. I mean, it's been quite volatile. It's probably changed the most. But even in the US, you've seen that as well. You've seen yields rising. So it's a very valid question. Certainly within our strategy, we haven't had much in the developed market. Government bonds haven't seen much attractiveness there. We've seen more attractive in the corporate landscape, where you can buy corporates that are much, much more solid, we think, in terms of balance sheets and safety of that coupon. But also in the emerging market world, where I was just looking at the forecast for inflation for the developed world and the emerging market world. And usually the emerging market world is a percentage point or two above the developed world. But actually for this year, it's forecast to be just below the developed world. So lower inflation, but higher growth and lower debt levels. So overall, the emerging market world actually looks in quite a good relative position. And yet you get much higher yields over there in the emerging market than you do in developed markets. So if I could buy a US Treasury for a 10-year Treasury for 4.5%, I could buy a Mexican Treasury for 8-9%. So there's and inflation's lower, so there's definitely an attraction there, and so that's where for some of our income needs in the strategy, that's where we go. We go to a select middle class of emerging markets where they're very stable. The fundamental metrics are better than in developed world, but you get paid a higher yield for investing. So yeah, absolutely agree your point.
And so we've just talked there about the deficits being a risk, and they're coming home to roost in some respect. You also talked earlier about not being too scared of volatility, and of course we've got the ongoing sort of trade tariffs, which are causing immense amount of volatility. So you also mentioned diversification as a way of mitigating that risk. So can you talk us a little bit more about how you would smooth that journey for investors?
Well, I think it's very natural. One thing we hear a lot from investors is that they just want to stay in cash at the moment because it's too uncertain. And I think it's a very understandable desire, especially if people are either approaching or in the retirement. The safety of cash is understandable, but for me, I can see why that could be fine in the short term, but most people, or a lot of people, they need their pension pots to keep working for them. They need to keep growing those pension pots because they're not big enough. And so actually the challenge is, how do you stay invested, but do so while having the comfort that your income is going to be nice and stable, so you can get what you need in terms of the income for your retirement. And you've also got a collection of assets that should be relatively stable when there's a lot of volatility out there. So that's exactly what we're trying to do in this strategy. So that's we've got 9 different asset classes, and broadly speaking, a third in equities, a third in different types of fixed income, and a third in property and infrastructure, or so-called real assets. And the point of doing that is exactly that, to get the diversification. So we've done a lot of modeling historically to look at what happens to one asset class during any kind of shock or volatility. We're looking for asset classes that do other things during that time, so you diversify away the risk. And that's how we ended up coming up with that mix of asset classes. So you see, it's much more stable, both in terms of the capital, but really importantly in terms of the income, because you're able to harvest the natural income from the portfolio, and you're not forced to sell any assets when markets are down. So that's a really important point. And although we lagged a little bit last year in terms of performance, because we don't have a lot of the US tech names they don't pay much income, so they're not part of this portfolio. We did lag a little bit last year, but you've seen over this year to date, we've held in really well. Our fund's been really resilient, done well. It's because it's more stable, and that's because it's the type of assets and the diversification we have in there.
And so, because in your literature you define it as resilient income, so you've mentioned that that's all. In practice, that's down to that 9 different asset class mix. So how often are you rebalancing that, or how often are you looking at the individual kind of line items and moving them around?
Yeah, we have a strategic asset allocation, that a third I mentioned roughly, and we redo that every 2 years. So we don't do that every day. We're looking to capture the big strategic changes. So that's we really focus on that when we do that every 2 years. But we are very active in terms of thinking about how the portfolio should be changed at any point. So although we have a quarterly asset allocation process, we really discuss that every day around the desk. What should we be doing tactically? Is there an area that looks more attractive? Because we know that the strategic won't be the right asset allocation at all points, so we need to try and work out what the best one is. So we will be allocating actively away from that strategic asset allocation. And for example, at the moment, we're overweight property and infrastructure. That's 2 areas we really like at the moment. So that's what we'll be doing. But in terms of how what we're trying to do here is, as I was saying, get a really resilient income that is growing in line with inflation. We think that's what people want in their retirement. And when how do we achieve that? Well, one of them is diversification. So having lots of different asset classes is crucial to that. So different things are happening at different times. And that's also a global diversification. So it's not just, we're not a UK-based fund with many investments outside of the UK, very global. So it's the type of investments we're looking for within each asset class. So I talked a little bit earlier about the types of equities we would hold. So the more resilient, stable equities that pay a dividend and are not going to cut that dividend. And it's similar across all the asset classes. So within emerging market bonds, I mentioned we're looking for that kind of middle class of emerging markets, the ones that are more stable. So that's what we're looking for. Similar within property, we're looking for those REITs that have a nice, steady, growing income, are not going to cut their dividend. That's absolutely key. So we've got bespoke, directly invested portfolios within each asset class within here at Baillie Gifford, with teams looking at all these. So they're investing in. So that's really the key, I think, to resilience, making sure that they know each underlying investment really, really well. An example would be when we were through COVID, we've got a high yield element to the portfolio, around about 10, 12% of the portfolio has been in high yield. And everybody was scared of high yield during COVID, not knowing which bonds would default, which companies were going to be okay. We knew our companies really, really well, and we had the absolute confidence that these guys are going to be okay. We can still hold this portfolio, rather than some an index holding in high yield, but you wouldn't know all the companies. That's the kind of investment we're doing. We also spend a lot of time forecasting the income. So we've got a very complex system that forecasts the income across all the different asset classes, so that we have the visibility on what that monthly income will be, and we can tell our clients
that. In different scenarios as well? Like, I suppose, stress testing for weaker than...
We do stress testing.
Yeah.
Yep. So we have a stress testing twice a year. We will do that for different environments, how the portfolio will perform, and that can be really useful. But the bit I was referring to was the forecasting of what our expectation is for income, and it's pretty accurate. So, and I was just going to say, last thing on this one was that we had a massive stress test of this approach during COVID, and we guide our clients that we wouldn't expect our income to fall by more than 10% in any one year. We know it's not an annuity. We know it's not guaranteed income. We are investing in a whole range of asset classes, but from talking to clients, that was the kind of level that was acceptable to them. Anything less than 10% is it's not perfect, but it's okay. During COVID, we saw UK equities dividends fell by over 50%. And yet our income kept within those guidelines, so it didn't fall by more than 10%. So we felt that was a massive stress test of the approach, and we feel comfortable to say that we've demonstrated that this approach brings a resilient income.
I suppose you don't actually need to do a rehearsal. The market is giving you enough at the moment. So with these tariffs and COVID and Ukraine, there's a lot going on.
Well, there's always something to worry about. Yeah. You find that everyone loves to worry about something, and the challenge is sometimes just to look through the noise and actually see what underlying of what is going on, and try and avoid some of that noise.
Okay. I suppose, Brian, let's move on. I noticed in the Q1 update, you should be just a couple of minutes on this one. You noticed a shift away from equity-led returns. So you're pivoting more towards those real assets and bonds, which are showing more resilience. You mentioned there the property is also via REITs. So maybe you could talk about some of the resilience of the bonds and the real assets, and maybe some liquidity comments around liquidity.
That's an important point. Yeah, so our property and infrastructure is listed property and infrastructure. It's not directly invested in private markets. So it's listed in REITs for property, and in in infrastructure companies, just equities. So that's an important point to note. So very liquid, no issues with liquidity whatsoever in the portfolio. And yeah, I think I wouldn't describe it as a pivot away from equities too much, but it was more a case of where do we feel really attracted to. It was other areas in equities. So our property and infrastructure specialists were really enthusiastic about the opportunities in both those sectors. So it was that, rather than really not liking equities, that was the driver for that. Equities, we felt that they're the lowest yielding part of the portfolio, but we expect them to be the fastest growing. So that's the function it performs in the portfolio. But we felt that the valuations were maybe a little bit high. It wasn't attracting us, whereas the valuations in property and infrastructure were much cheaper. Those two asset classes have had a tough time over the last few years. They've suffered from this interest rates going up. They're a bit like bonds to some degree, because of the cash flows are quite reliable and long dated. So they suffered a bit like bonds suffered, and they were just they look pretty cheap. They haven't really recovered from that yet. So that was the attraction. And our specialist teams had found a collection of investments in these asset classes that they really liked, and they said, look, they're doing really well. The market just doesn't like them at the moment, but we think they're great, and so it's something that we think we should add to. So the infrastructure space, for example, it's funny because in the utility space, or utilities within infrastructure, they might be seen as a bit dull, and I think it's probably fair to say they have been a bit dull over in different periods in history. Now that's why people like them sometimes, because they pay 4 to 5% yield, and the cash flows are very reliable. It's almost like a bond. So and some of them are inflation linked. A lot of them are inflation linked, actually. So there's a lot to like from a retirement income point of view, but maybe a little bit on the dull side. But actually, the prospects for, if you pick the right ones, are actually a bit more exciting than that. They have the nice dullness, but they can also add on some additional interesting features, and it's to do with, the allowed investment. So if an infrastructure company, utility, is allowed to invest more by its regulator, then it's allowed to earn a higher return overall. So that's an attractive feature. So if you find an area of the utility space that's investing a lot and is allowed to invest, then that's attractive. So in the water industry in the UK, and also some very negative press to do with Thames Water, and that affected the whole sector to some degree. So that was the opportunity for us. So Severn Trent and United Utilities, much better run than Thames Water, and yet in that sweet spot of very reliable cash flows, but an opportunity to invest and get higher returns. So that's the kind of example of something that's attractive in that sector, well run, but with a really good runway for growth.
And like digging beneath the headlines and in a sector with kind of headline risk, I suppose. So doing your homework.
That's often the opportunity.
Yeah.
Yeah, because people tar everything with the same brush. So that's often the opportunity to get in there if you know the companies really well.
Excellent. And also, you've mentioned a couple of times throughout that the fund is global in reach, but when it came to sort of listed property, the UK in particular was looking attractive. Can we just spend a couple of minutes understanding the investment case there?
Sure. I mean, I think it's the value opportunity we've been attracted to, and it's been a difficult few years adjusting to higher rates that I mentioned earlier. But you've seen, it's in particular in the UK, but the discounts to net asset value that these REITs are pricing at is really attractive, and the UK probably the most attractive region globally. I just think there's too much negativity priced in. These businesses are really well managed. The leverage is well controlled. The assets are marked to market, regularly. Rents are growing. Balance sheets are strong. But yet you're seeing the likes of, I don't know if you know Shaftesbury, but Shaftesbury owns much of prime assets in London. I mean, it's the best portfolio of assets there is, really. Covent Garden, Carnaby Street, all these are really prime real estate.
Top of the Monopoly board.
Exactly that. It's trading at 30% discount to its net asset value, where the mark to market value of the property is, and so it just feels way too cheap for us. And we can get a 5.8% yield on Shaftesbury, so that's a really attractive thing for us to be investing in the portfolio. And actually, it's really interesting because you're seeing a lot of the smaller REITs getting taken out at the moment. There's been a lot of M&A activity with private equity coming in, so the public markets are not as interested in these investments. Don't seem to be paying what we think they're worth, but the private market is. The private market's coming in, and it will correct over time. But so we're very happy just sitting there holding that for the moment, and we'll see the market gradually correct. So yeah, property, and in particular the UK, is probably one of our most interesting investments at the moment.
Excellent. And just a couple of last questions before we go to the Q&A. The first one is on the income distribution. So you've indicated a 5% increase in the fund's income distribution for this calendar year. So what is driving that growth, and how sustainable is it in the current market environment?
Yeah, I mean, so we're trying to grow our income in line with inflation. So UK inflation between 2 and 3 at the moment. We'd expect at least that. And to be fair, we're actually catching up a little bit. We lagged the big burst in inflation, so we're catching up with that. So there's a bit of that. Our companies are just putting through price increases that are boosting their earnings. We're seeing just good growth in earnings coming through the whole portfolio. So through the property and infrastructure space, we're at 5% earnings growth and dividend growth coming from all these investments. Within the fixed income side, there's a bit over the last few years of yields have risen, and therefore there's a little bit of reinvestment coming in at higher yields, and that also has helped to boost the income a bit. But most of it is the natural income growth in the portfolio, and absolutely we think it's sustainable. Yeah, that's what we'd expect to see over the years to come, that income growth beating inflation. And that's apart from the blip in inflation that we saw when it went very high for a year. That's what we've seen every year.
Excellent. And finally, for investors nearing or in retirement, let's discuss some implementation. So what role can the monthly income fund play in supporting their long-term income goals? Would you see it as a core solution or more of a sort of a complement within a wider portfolio?
Listen, I think everyone's got their own situation and own needs, but for us, we see it as being a core solution for people. And I think we see the three key risks when you're at that stage looking at your retirement income. One of it is what is known as sequencing risk. And that's when you have to sell assets to generate your income. And you get the risk that you have to sell when the market's down. And that can really affect the path of future returns. That's what we call sequencing risk. And that's something that, if your strategy is to have a portfolio of equities which you sell down to generate income, you're running that risk. And especially when we see all the volatility in the markets at the moment, that's probably a bit more front of mind than maybe it was for periods in the past. So that's something that we avoid because we have a natural income being harvested from the portfolio, so we don't have to sell any assets at any point to generate the income. So that's one of the risks that we think we mitigate really well. Another risk is longevity risk, which simply put, it's the risk that your money runs out before you do. And that's a big fear for everybody. And certainly if you buy an annuity, then I guess what that's going to be. But it's you're not making your assets work as hard as we think they should. So you got to be aware of sequencing risk, but you want to keep invested. So you want to keep your assets working and generating a return for as long as you can. So that again is what we are doing here. We're keeping our assets invested in what we think is an optimal mix of assets to give you that nice income. Currently, we yield about 4.4%. So looking to give that nice yield and growing that income over time and growing the capital. So that takes or helps alleviate as much as we think is prudent that longevity risk. And the third risk is the inflation risk. So when we started the fund back in 2018, nobody bothered about inflation. This was like inflation that's been low for decades, but actually we all know that, inflation's a bit higher or has been a bit more worrying. And so inflation can be a really, really negative thing for your portfolio. If you have an annuity, a nominal annuity, then inflation will just erode that significantly over time. And it's over longer periods, it really plays out. So you need to be mindful of that inflation risk. So again, that's directly in our objective to keep pace with UK inflation. So we're very mindful of that. We know our equities should have pricing power and they should keep pace with inflation. Property infrastructure, they're real assets. They should keep pace with inflation, and our fixed income is there, to provide that higher income over time to get ahead of inflation. So there are different approaches to these things. We think our approach stacks up really well in terms of how we go about it. So I would class it as a core solution, and we've got a fee of only 50 basis points in this strategy. So we think it's value for money as well as being a very good core solution for people.
Excellent. So very much a sort of three-pronged approach there. So excellent. Well, we've got to the end of our interview part of the session, and I've got an inbox full of questions here. So let's use the remaining time to kind of work through some of those. So the first one. How does your fund differ from Baillie Gifford Defensive Growth? So we mentioned that quite up top, didn't we? So just maybe a few pointers there on the differences, the key differences. I suppose it's the asset mix, isn't it?
Yeah, defensive growth is actually one of our multi-asset strategies. So it's actually quite similar to monthly income in terms of the fact it's diversified across lots of different asset classes. The difference there is it doesn't have an income objective. So it's not looking to pay a high income. It's got a volatility constraint at the total. It's a total return strategy with a volatility constraint. And so they would be a lower income. Would have a lower income than we would have. Whereas as I said before, I think it's really important. If you want an income, you have to really focus from an investment point of view. So we'll be doing slightly different things on the investment side to make sure that we've got enough income being generated in the portfolio. But overall, actually not that dissimilar in terms of what those two funds are doing.
Okay, now we've got a very functional question here. What is the full name of the fund? Is it an OEIC or an investment trust? So just some clarity on, I know there was a name change recently, so maybe we could just clarify the full name and the structure so everybody knows what they're dealing with.
Yeah, it's Baillie Gifford Monthly Income, nice and simple. It's a UK OEIC.
Okay, excellent. Then could we have some examples of infrastructure investments. Okay.
Yeah, so I mentioned the utilities earlier. So we've got a number of utilities. Terna is another one. So Terna manages the Italian electricity grid, the transmission grid, and as you can imagine, there's a lot of investment in the grid to try and connect up renewables and make it fit for a greener future. So Terna is allowed to invest a lot and to earn a higher return on that. So that would be. It's an example, a bit like the water companies earlier, where it's a very nice steady set of cash flows, but more of an opportunity for growth than you maybe have had in the past. Not a dissimilar story, but in the US, we hold quite a lot of US utilities as well. And again, that's about the build out of the grid. It's about data, the need to power data and use of AI, etc., and energy demands, and so there's a bit of generation going on with those utilities as well. But these have all done really well over the last 4 to 5 months because people like the reliability of the cash flows, especially when general equity markets are a bit wobbly. And so that's where people like to feel nice and safe in the utility space. So those are some. Probably at the racier end of our utility exposure would be Greencoat Wind. So looking at the UK renewable sector. So these are trusts which have been, really a bit unloved by the market, but and they're paying a yield of about 8%, and something that we think. These are very reliable cash flows over many years, and the market is again making a mistake by not pricing these higher. But in the meantime, we're happy just to pick up the income and see what happens. So a variety of things in the infrastructure space.
There's a kind of a similar question, tapping into those same themes. Are you invested in energy companies that are at a discount but paying high dividends?
No, we're the only investment. It was renewable energy would be the only space would be in, and we have a few holdings within our infrastructure space. So NextEra is one in the US that's in Florida, power generation with a big renewable part to it. So, and then we have some in the UK, which I mentioned, UK Wind, Greencoat Wind. So a few holdings in the renewable space and a bit of energy coming through through the US utilities, but not just energy companies on their own, no.
There's a question here on yield. So it was mentioned earlier that the income distribution will be sort of 5% higher than last year. Is that the fund's yield?
This is a great question because it allows me to tackle one of these things that people just tend to get confused about, and I don't think the investment industry does a great job of explaining it. So often people will look at just, if they're interested in income, they will simply look at the yield on a strategy. Now that tells you what your income is going to be when you buy it for the next year. So our yield at the moment is 4.4. So if you invest 100, you will get 4.4 income in that first year. But what you really care about if your retirement income is what you're going to get in year 2, year 3, year 4, year 5. So that's what we're about, is growing that 4.4 every year. So we're looking for that to grow at least in line with UK inflation every year. So that 4.4 should be up to 4.5, 4.6, and the more the better. But as I said, this year we're looking at 5%. Last year it was about 5% growth as well. Whereas many strategies in the market, especially just a bond fund, will show you a nice high yield, and they'll pay you that nice high yield in the first year, but that will drop over time, or at least drop in real terms. It won't keep pace with inflation. So you've got to be very careful about what you care about as an investor. It's what income you get, the actual money you get in your pocket. That's what you care about. So don't look too much at the yield, but look at what income and what the income growth is likely to be for that strategy. And that's why we don't hold all our money in high yield bonds. If we could do that, but if we did that, we would see our income decline in real terms over time. And that's not what people want. They want it to keep pace with inflation. And that's why we have to invest a third of it in equities, because that's the only way we can get the growth of that income coming through. And infrastructure and property can also grow the income, maybe a little bit less, but they can keep pace with inflation. So that's why we have that mix. in order to grow that income over time.
And I imagine those holding periods then, in order to generate that income, are quite long. Would that be?
Well, I mean, it should come through every year. So as I say, we're expecting 5% every year, but we typically would hold. We're quite a long-term holder of most of our investments. We don't flip them. We're looking to be a long-term investor for many of these companies, and many of them we've held for the 5-6 years of the strategy already. So that's typical. But yeah, what we're looking to do is find companies and investments that we can rely on to pay that income, whether it's the coupon in the bond or the dividend in the company, and just looking for what we really don't want in the strategy is dividend cuts. So a company that's more in a really volatile sector, or it's badly managed, you'll see dividend cuts, and that's what we don't want. That's what our clients don't want. Same with the bond. We don't want bonds to have to default on their coupons. That's the last thing we want. So we want to be nice, stable companies or countries that are going to just consistently pay their bonds, pay their coupons.
There's a two-pronged question here. Many REITs and investment trusts in general are currently suffering from a significant discount. How would you mitigate this? And then the second question is, you mentioned 9 different asset classes for diversification. Can you list them, please? So maybe let's tackle the first one with the REITs and investment trusts and the discount.
Yeah, I mean, it's not really for us to tackle in a sense. That's just a fact that they're trading at a discount. And I think, for us, it's not really a sustainable longer term position. I think it comes about because you saw a lot of generalist investors come into the property sector, a good number of years back, and they've come out and haven't gone back in again. And the reaction to rates going up was quite negative in the property world. So, you did see REITs, have a bad couple of years, and I think that scared some people off, generalist investors. So again, we've got specialist investors who are involved in this all the time. So I think it's maybe about that generalist market hasn't come back, and so what you're seeing is that private equity is coming in, and that's narrowing the discounts because they're coming in and doing M&A and taking these REITs private. So I mean, that's the process that's undergoing. It'll probably be quite slow, but we'll see these discounts narrow. But in the meantime, we're buying these assets that are they're generating a really nice rental income. So there's no concerns about the businesses. It's simply a valuation of them. They're generating a nice high rental income, and that just flows through to us. So REITs have to pay out a high proportion of their rental income, so we can effectively buy that rental income cheap. So that's a good situation for us. That's something we've done. We have about 12% of the portfolio in REITs. On the second question, on the 9 different asset classes, so we have equities, property and infrastructure, that's 3. And then we have 5 different bond asset classes. So government bonds, investment grade corporate, high yield corporate bonds, emerging market local currency bonds, so issued in their own currency, and then emerging market hard currency bonds, which is issued in dollars or euros. And then we have cash. So that's the 9 different asset classes.
Okay. So of course, within that, there's nothing in there to say unlisted securities or private equities. So there's a question here: what's your exposure to unlisted securities, private equities? Zero. Yeah. Maybe some comments on perhaps why it's not as suitable for income generation.
Look, it may be suitable. It's not a real judgment on that. We just wanted this fund to be really simple and very liquid, and we feel we have lots of opportunity to get exposure to enough growing income and resilient income. So we don't feel we need anything else from those sectors, and we acknowledge that there's less liquidity and it's a bit more complicated, and we want everything to be managed in-house. We do our own ESG sustainability analysis on every investment. We know everything really well, and that's the reason why we stick to listed, daily dealt investments.
Excellent. There's another question here. So you're a co-manager on this fund. So who else manages the fund with you?
Yeah, so we have a representative from every asset class involved in the management of the strategy, but there are four of us that are on the portfolio construction group. So it's myself, it's Leslie Dunn, who is head of our credit teams. We have Nicoletta Dumitru, who looks after our infrastructure portfolio, and we have John Stewart, who looks after our property portfolio. And so it's the four of us that make the decisions in the fund.
And you also run another fund, so the managed fund. So how does the asset allocation compare between the two?
So the managed fund is as we were talking at the very beginning of our chat, is one of the accumulation strategies at Baillie Gifford. So in some ways it dovetails into monthly income as you age. But the managed fund it's not only equities, it's 75% equities, 25% bonds and cash. And it can asset allocate between those. So it's managed in the sense of managing that overall exposure. But the 75% in equities is the biggest driver of that fund, and there's no income requirement on any of those equities. It's much more about capital growth and wealth creation. And we have regional equity portfolios make up that 75%. And then I look after the fixed income part, and help to do the asset allocation with my co-manager, Ian McCombie. And we listen to all our regional equity managers and underlying fixed income managers when we do that asset allocation.
There's a few questions come in along the same theme, and it is around inflation expectations over the medium term, so the next 2 to 3 years. So you've got a history in fixed income, you've worked at the Bank of England, so it feels like you've got a good handle on this. So, and it's going to be increasingly important, as you've mentioned throughout the webinar, that your strategy needs to outpace inflation to be useful for investors. So what's your take on where it's headed in the next 2 to 3 years?
Yeah, I'm actually fairly relaxed about inflation now. Looking ahead, I think the immediate future, the next 6 to 12 months, it's always quite difficult to predict with a lot of accuracy. But I think we're seeing the underlying drivers of inflation be pretty contained and continuing to fall. There's obviously a bit of a bump in the road with the tariff impact, so that probably in the US, we'll see a bit of a blip up in inflation as the tariffs come in, depending what level they're at. But that will just be a one-off impact that will come away again. So I'm not worried about that, and the central bank wouldn't be worried about that because they'll see it come back out the numbers in a year's time. So, but the underlying trend for me and for inflation is I'm quite relaxed about it. It's principally because of the use of AI. Excuse me. I think AI is going to transform the picture for inflation. A bit like what we saw in the 90s with the advent of China coming into the global trading system. We effectively had a massive increase in global labour supply, which meant that labour markets weren't as tight and you didn't get as much wage inflation, and you saw decades of disinflation. I think AI is a similar theme. What's difficult to know is how quickly it plays out. My guess is that over the next 2 to 3 years, we will see downward pressure on inflation from AI. That doesn't mean we're necessarily going negative or anything. It just means downward pressure. Because if you think about it, if people have in many jobs now, if they're needing an extra person or if somebody leaves, they will try and replace that person with AI. And I think if we're already seeing that and the pace of development of the AI models, I think we'll see more of that to come. So I'm actually pretty relaxed about inflation going forward. I do worry about, it's not all glory for bonds though, because that would normally make you quite bullish on bonds, but I think there is a risk still on the fiscal side. I think long dated bond yields may stay quite elevated because of the risks to do with high debt levels. So it's a bit of a double-edged sword for our
so like staying at that shorter end of the curve and staying diverse. Yeah. Diversified.
Well, absolutely, staying diverse and maybe staying away from those US Treasuries and gilts and those things, and holding other types of bonds. And as you say, maybe shorter dated bonds will benefit more from the inflation angle, if I'm right.
Excellent. Well, that is all we've got time for. Thank you so much for your time. Thank you, Stephen, for your time and insights, and thank you for watching. And we have more sessions like this coming up, so do keep an eye out for those if you found today useful. Thank you, everybody. And goodbye.